Hi there. We are going to continue with our more in-depth consideration of the balance sheet, and we are to the last portion of the balance sheet, stockholders' equity. So this is Class 34A if you're Monday, Wednesday, Friday, and Class 24A if you're Tuesday, Thursday. Alright, we are on to Chapter 13. And a lot of this should be pretty familiar. So let's talk about stockholders' equity and what's going on with that. So first of all, we need to realize that when we're talking about stockholders' equity, we're dealing with a corporation. So let's talk a little bit about corporations first. And I don't think any of this is really new. As introduced in earlier chapters, a corporation is a business organized under state law that is a separate legal entity. Corporations dominate business activity in the United States. Most well-known companies are corporations and tend to be large multinational businesses. So it's separate from the person who owns it. That's one of the important things about corporations. So let's talk about the factors for corporations. But as you know, there's different ways to organize businesses: sole proprietorship, partnership, corporation. And that's what we've pretty much been following all semester, the corporate financial statements. Alright, so what are some unique characteristics of corporations? A corporation has many unique characteristics. It's a separate legal entity. A corporation is a separate legal entity. It is organized independently of its owners. So for a corporation, it's its own separate being. You don't have to be a human being to be in business. You can be a corporation, and humans own the stock. Or other corporations own the stock, right? Number of owners. Corporations have one or more owners called stockholders. Right? So corporations issue stock. That's how they're owned, through the stock. A public corporation is a corporation whose stock can be purchased on an organized stock exchange, such as the New York Stock Exchange or the NASDAQ stock market, NASDAQ stock market. So public companies. So these companies, when you can buy their stock: Disney Corporation, Target Corporation. You can go on a stock exchange. Dell. Dell's private now, no longer Dell. But Microsoft, Google, Apple, public corporations. You or I could go and purchase stock in those companies. That's public companies. Some corporations are privately held, which means the stock cannot be purchased on a stock exchange. These corporations often have only a few stockholders. So I always like to use the example of HEB. HEB is a corporation, but you and I can't go out on a stock exchange and buy HEB stock. Pretty much that belongs to the family and maybe a few other people, but just a regular person can't go on a stock exchange and just buy HEB stock. However, it is a corporation. All right. No personal liability of the owners for the business's debts. Stockholders are not personally liable for the debts of the corporation. So that's one of the big features, is that these corporations are standalone entities. So if the corporation gets in some kind of trouble, it can't pay its bills. They can't come to the owners to try and get that money. Lack of mutual agency. Stockholders cannot bind the business to a contract. So just because you bought stock in Microsoft doesn't mean you can operate on Microsoft's behalf. Microsoft doesn't operate on your behalf, so it goes both ways. Indefinite life. Corporations have an indefinite life, so a big corporation can be here long after we're all gone. IBM has been around for a really long time. Corporations can go on for forever. Taxation. Corporations are separate taxable entities. Capital accumulation. Corporations can raise more money than sole proprietorships and partnerships. This is completed through an initial public offering, an IPO, maybe you've heard of IPOs, and represents the initial offering of corporate shares of stock to the public. So companies raise a bunch of money, because they're going to go on forever, and they can sell to a lot of different owners, so they can issue stock to a lot of people and raise a lot more money. Sole proprietorship only has the proprietors to get money from, and a partnership can only get money from the partners or borrow, right? So corporations have this idea that they can increase their equity and issue stock through IPOs. So let's talk about the characteristics in a table form. So if you want to memorize these characteristics, you go to page 647. Exhibit 13.1 summarizes the advantages and disadvantages of corporations. So advantages: raise more money, has continuous life, transfer ownership is easy, you just sell the stock, no mutual agency, so you don't speak for each other, the owners and the corporation are totally separate. Stockholders have limited liability, so if the corporation gets in trouble, the people they owe their debts to can't come after you just because you're an owner. Disadvantages: ownership and management are often separated. So you may own a company by owning its stock, but the managers don't really answer to you unless you had like a bunch of the stock. The earnings of a corporation may be subject to double taxation, so the corporation itself gets taxed, and then the people who get the dividends or sell the stock and get money, they get taxed. So that they call that double taxation. Government regulation is expensive, so you and I can go start a little restaurant, and it's not a big deal. We just run our restaurant. We don't have to worry too much about regulations. But corporations, lots of regulations, lots of rules they have to comply with, so it costs a lot to keep up with that. And startup costs are much higher than other business forms. So I can just go, if I get enough money to start my taco stand, I can open it up. But corporations actually have to prove that they have a certain amount of capital and prove it to the state before they'll be given their certificate of incorporation. So it's it's a higher level of operating. Stockholders' equity basics. So if we have a corporation and people buy stock in it or own stock in it, then they have equity in the company. We call that stockholders' equity. A corporation is created by filing a certificate of formation with a state. The state authorizes the business to be organized as a corporation and grants the entity a charter or articles of incorporation. So you go to the state and they give you permission to be a corporation. The corporation then prepares a set of bylaws which provide the rules and procedures that the corporation will follow. The corporate charter of a corporation identifies the maximum number of shares of the stock the corporation may issue. So authorized stock is the maximum number of shares that the corporate charter allows the corporation to issue. Authorized stock can be issued or unissued, right? So in other words, when a company incorporates, they say we're going to have 1 million shares of stock, or we're going to have 1,000 shares of stock, or we're going to have 10 million shares. So they say this is how many shares of stock we want to have authorized. Now, they don't always issue all the stock, so they say we want about 10 million shares of stock, whatever, some number. The company gets to choose. Then they can either issue it out to people, to the owners, or not, right? So authorized stock can be issued or unissued. Issued stock has been issued but may or may not be held by stockholders. A corporation issues stock certificates to the stockholders when they buy stock. A stock certificate is paper evidence of ownership in a corporation. The stock certificate represents the individual's ownership of the corporation's capital, so it is called capital stock. Outstanding stock is issued stock in the hands of stockholders. So once a company decides to sell some stock out there to people, they issue it, and then people give them money, and that stock gets issued out, and they get a stock certificate. Certainly companies can buy back their own stock. So just because it was issued doesn't necessarily mean somebody outside the company holds it. We'll talk about that later. So there's this idea of outstanding stock and stock that you've repurchased. Right? Outstanding stock is in the hands of stockholders. So here's the idea of the stock certificate. All right. So when a company issues stock, it sort of like we did bonds. There's going to be a piece of paper that says you own these many shares. So here's an exhibit. It's on page 647. It shows a stock certificate for 288 shares of Smart Touch Learning common stock owned by Courtney Edwards. The certificate shows the following: company name, stockholder name, number of shares. So issuing stock, there actually is a piece of paper that gets issued. A lot of times people buy their stock through a stockbroker, so they don't really get the piece of paper. The stockbroker just keeps track of the account for them, kind of like a bank account. You know how you have a bank account and you don't really have the cash, but the account represents that amount of cash? Same thing with stocks. You buy stocks through some kind of broker and you have an account. Yes, paper stock certificates exist, but you really just have an account. But yes, you're going to be issued some amount of stock and it's in your name. So here's how stock works. All right, remember we have authorized, issued, and outstanding. So this little bullseye is kind of giving you an idea of from most stock to least stock, how stock can exist for a company. So the outside ring and everything inside represents authorized stock. So that's the maximum that can be out there. So the most you can have is in this blue ring right here. So if you say, we're going to authorize 10 million shares, right? Then after that, represented by this yellow ring, so this yellow ring and everything inside it represents issued stock. So for stock to be issued, it has to be authorized, so it has to be within the authorized. So authorized stock, then some of it gets issued, maybe not all. So you can imagine we've authorized 10 million shares of stock and we're going to issue 7 million, right? So that 7 million stock gets issued. The red circle in the middle, that represents what's called outstanding stock. So you can imagine when a company first starts, they say, well, we'd like to have a maximum of 10 million shares. That's authorized. Then they go ahead and issue some. They issue 7 million, right? So that's issued. Then over the course of some years, that company buys some back, or maybe they merge stock. They do a reverse split, and you have 2 shares turn into 1. Maybe they do something so there's less stock outstanding. So it's still issued, but it's just not outstanding anymore. So that's the inside circle. So outstanding stock has to be issued. Issued stock has to be authorized, but not all authorized stock is issued, and not all issued stock is still outstanding. Venn diagram. All right. Stockholder rights. So once you buy some of these stocks, you have some right. A stockholder has 4 basic rights unless a right is withheld by contract. So when you buy stock, here's the basic right. So unless it specifically says you don't get to vote, or it doesn't come like this, you don't get dividends, then that doesn't come. But basic stock, if you go buy stock, this is what your rights are. You have the right to vote. Stockholders participate in management indirectly by voting on corporate matters at stockholder meetings. This is the only way in which a stockholder can help manage the corporation. Normally, each basic share of ownership has 1 vote. So if you have 1 share, you get 1 vote. If you have 50% of the shares, you get 50% of the vote. So that's why large stockholders have a lot of say in a company, and somebody like you or me who just has a few shares, we have not very much say in a company. So you have the right to vote. Basically, it goes by how many shares you have. Dividends. Stockholders receive a proportionate part of any dividend that is declared and paid. A dividend is a distribution of a corporation's earnings to stockholders. So we've seen this idea of dividends. So a stockholder is going to receive a dividend based on how many shares they have. Liquidation. So at the end, say this company decides to not be around anymore. Stockholders receive their proportioned share of any assets remaining after the corporation pays its debt and liquidates, goes out of business. So in the event a company liquidated, they split up everything between all the owners. Now, usually when a company liquidates, there's not a lot left, right? They've gone bankrupt, there's problems, so there's not a lot left to split up. But if there's anything left, you get it. You get your proportionate share. Preemptive right. Stockholders have a preemptive right to maintain their proportionate ownership in the corporation. This right, however, is usually withheld by contract for most corporations. So usually a big corporation doesn't let you do this, but smaller corporations, like probably an HEB or something like that, that issue stock, they'll say, in order to keep an owner's share from being diluted, right, diminished, made less, they say, well, if we ever do issue new stock, you have the first right to buy some more so you can maintain your 25% share or 50% share. They can't just issue more stock and kind of boot you out of management by doing that. So let's talk about capital stock. Corporations issue different classes of stock: common stock and preferred stock. Every corporation issues common stock. Common stock represents the basic ownership of a corporation. Preferred stock gives its owners certain advantages, just like the word implies. Preferred gives you advantages over common stockholders, such as the right to receive dividends before the common stockholders and the right to receive assets before the common stockholders if the corporation liquidates. Stock may carry a par value, or it may be no par stock. Par value is an amount assigned by a company to a share of its stock. Most companies set par value low to avoid issuing their stock below par. The par value of a stock has no relation to the market value, which is the price at which the stock is bought and sold. Some states allow the issuance of no par stock. No par stock is stock that has no amount assigned to it. Stated value stock is no par stock that has been assigned an amount similar to par value. So this is a weird concept, but when you get your stock authorized, right, you first set up by the state, you say we want 10 million shares, par 10. So you say $10. Maybe you don't really sell them for that. That may not really be the market value, but just to establish some kind of an equity basis, you say they're worth $10 a share or $5 a share, and we call that par. If you're in a state where they don't make you issue par, you just call it stated value. All right, stockholders' equity. A corporation's equity is called stockholders' equity. State law requires corporations to report their sources of owner's capital because some of the capital must be maintained by the company. There are two basic sources of stockholder equity. Right? Paid-in capital, also called contributed capital, represents the amount received from the stockholders in exchange for stock. Common stock is the main source of paid-in capital. Paid-in capital is externally generated capital and results from transactions with outsiders. So people buy stock, you get capital from that. Retained earnings is equity earned by profitable operations that is not distributed to stockholders. Retained earnings is internally generated equity because it results from corporate decisions to retain net income to use in future operations or for expansion. Retained earnings is equity earned by profitable operations of a corporation that is not distributed to stockholders. So you should know about retained earnings. We take our net income, take out our dividends, and that's our retained earnings. So paid-in capital and retained earnings either comes from outside or retained earnings from inside. So let's stop there, and on our next video we'll talk about actually issuing the stock.